Hello and welcome to another edition of the Goldman Guide. Hope you had a good weekend. We've got some great tactical information for you traders out there and some very deep information on ETFs, which is absolutely the rising giant in investing categories. And you don't want to miss this. If you haven't yet subscribed, make sure you click the red subscribe button so you can be alerted to our uploads every week. With that out of the way, let's get started. Investors seem to still not know whether to buy or to sell. Every signal is conflicting the one previous. Investment pros aren't helping either, as they seem to be on the fence or off the fence, and they really don't know what to do either, quite frankly. And we think we have this thing figured out, however, and more on that in a second. I saw some news last week on the ETF front that was just absolutely wild. It's very telling for a bunch of reasons, not the least of which is that investors who are looking for signals about individual stocks, whether or not they're a buy or whether or not we should avoid them, we're always looking for those types of things, right? And have some sort of pattern behind it. Well, this particular ETF may be a great proponent of a new strategy that could get some serious legs because it answers this question. So some important background here that I just want to mention. I have a good deal of experience on the ETF front going back 20 years when I was managing money as my firm introduced the first ever ETF-focused 401k that combined lifestyle characteristics that went out every 10 years. I was the CIO at that time. We got a tremendous amount of press, and I've been a huge fan of ETFs, of course, ever since. Now, last week, Harbor International introduced a new ETF called the Harbor Corporate Culture Small Cap ETF. Small cap version of its $10 million in asset Harbor Corporate Culture Leaders ETF that they launched last year. So what's so special about these? Well, they both target companies that have strong corporate cultures. And these are determined by the scoring system that's used by a company called Irrational Capital, which is founded by some great guys, huge guys, tremendous experience in the investment industry. And the methodology scores companies based on criteria like employee engagement and motivation, trust and transparency, the diversity of different points of view, and fairness in compensation. Now, on the surface, this concept is very noble, even though it's a little niche, so kudos to them. But I just don't know, is there really a correlation between stock performance and this human capital issue, this culture? I don't know. I can't say how well it will perform either, although I hope they do well. And if they attract a lot of assets, look for this approach to become a bit more common in other places. It seems a bit odd, but we are looking at new ways to generate consistent performance. And if there's a correlation here, then hey, these guys are going to do well, and it could be a new way to look at companies. So please keep that in mind, and we're going to monitor this pretty closely. Now, the indices and key securities, save for the mighty Bitcoin, only had incremental gains last week. Bitcoin, of course, ran over 10%. And this is an improvement over the week before, but it feels like we just have a few percentage points left gain-wise for these various indices, and not much beyond that. I mean, look at the forward PEs, they're just rising. NASDAQ 100 to 26, and you got where the RSIs in the 60s. It makes me a bit nervous. I have to admit that. So really, aside from the risk inherent in small cap stocks, I would probably say that it's the place to be, especially looking at these technicals here. But I'm not sure what the catalyst is going to be, and I'm not alone. Especially if you look at the AAII and fund flows. So if you look here, bullish, neutral, bearish on the AAII sentiment survey, they're essentially equal. No one knows what to do. What do we make of things? On the fund flow side, that's another question mark. Last week, Spider was a huge seller with 10.5 billion sold, and then we've got this week big inflows and only small outflows, although they're in tech and the Russell 2000. Now, ETFs are still increasingly becoming a source of capital safety. That's obvious with the way these have traded, and we're going to talk about more about that in a second. Their performance, doesn't directly move stocks, but it's another illustration that what happens here is really tangible as an indicator, even if it's lagging. Now, banks these days are really becoming extremely important based on what happened, of course, last month with Silicon Valley Bank, First Republic, and so forth, Credit Suisse. So the question is, we're in a bit of a credit crunch here, but yet the banks are, well, they're making bank. So what do we do? Should we be investing in the sector? Should we avoid it? I would continue to avoid it because there could be other shoes dropping here in the near term, even though these numbers are that are being reported are quite good. And as we see, of course, from the contrarian perspective, crypto is moving higher when banks tend to move a little bit lower. We've seen that a lot in recent weeks, and I think really that helps drive this consideration to some degree as well. And on the small cap side, I do think we are going to have this rotation. We're not quite there yet, just not quite there. But when volume starts to come back into space and with more regularity, it's going to show that the equity risk fear is dissipating. And the economic risk probably would have dissipated maybe even a little bit before that. Use those as signals. And in terms of the major indices and the big cap stocks, especially, are we near overbought? Absolutely. Are we overbought yet? Maybe, maybe. It certainly is a close one. Now, as I said before, we really are looking a great deal at ETFs this week and got some interesting news, which I think is very important to anyone that's investing these days, whether you're an investor in ETFs or not. So here's some interesting news. According to a survey last week by PricewaterhouseCoopers, PwC, global ETF assets could reach $11 trillion by 2027. And it's already at $9 trillion, and 7 of the 9 happens to be in US ETF assets. Now, how important are ETFs in general? The largest ETF provider is the fourth largest fund company in the country, and it accounts for 25% of all ETF assets in the US. Plus, one of the biggest, happens to be number 8, in the mutual fund company size category in the US, is now hiring a head of ETF capital markets. Clearly, ETFs are really becoming important these days. Not that they haven't been the past few years, but as I mentioned before, a source of safety, becoming important in fixed income, as it relates to the VIX, as it relates to a way to trade the major indices, also in the options market. And what I find very interesting is while the US equity ETFs represent about 14% of all equities, during the first quarter, US ETF trading volume accounted for nearly 40% of trading in March. It averaged over 31% for the entire quarter, but March's volatility had this huge impact. We could be at 50% if we have another volatile period later this year. That's unconscionable. It's unheard of. We never thought it would be something like that in the near term. But it's important to note, and why we're going to focus from time to time a little bit deeper, a little bit broader on the ETF side, both niche industry-based ETFs as well as the larger ones in terms of assets under management. Now, according to iShares, the major moves in VIX and ETF-related VIX assets were a big driver in March. And we've been repeating this mantra for months now, so we're not surprised. And the insanity in interest rates and inflation has prompted or renewed new interest in fixed income ETFs, notably U.S. Treasuries, which we've been repeating as we've been following what's been happening with redemptions as well as the inflows on the ETF side. This fixed income trend is palpable and could continue until rates begin a potentially prolonged decline. Now, interestingly, ETF equity average volumes are still below last year, which is an indication of both the big loss that investors took last year, as well as an indication of fewer investment dollars that are still, well, quite frankly, going into equities. Now, our take on all of this in general is that ETF assets trading will be on the rise for an ever-increasing large percentage of assets in trading in the U.S., globally as well. And this segment is a go-to source of trading for things like VIX, strategic positioning for fixed income, diversification in the large percentage of equity holdings like S&P 500, and specialization these niche industries and approaches like we talked about earlier. But still, direct ownership in individual stocks, and large, mid, and small cap for that matter, are the preferred strategy. And small caps and alternative assets may carry higher risks than ETFs, but the upside there and a sense of participation and pride that we as investors get in the success of the performance of these equities always plays a role in their underlying attraction. Cannot be overlooked, cannot be forgotten. Well, that will do it for this week. Thanks for listening. We hope you enjoyed it. If you have any ideas about anything we discussed today, please drop me an email. Of course, everything that we discussed today is just for informational purposes only. Thank you very much for your time. Greatly appreciate it, and have a great week.